let's kick things off. So a couple weeks ago, you and I sat down to talk about decentralizing stablecoins, some of the different mechanisms that different stablecoins use to operate, and some of which of the vectors might be more centralized or less centralized, and some of the risk factors there. I think we're going to kind of today dive a little bit deeper in what that means for the average person, and why some mechanisms, designs, structures, bases of value might be better or worse than others for certain use cases, certain types of people and segments, and kind of go from there. Does that sound fair?
Yeah, that sounds about right. I mean, I'll start off, and I
Yeah.
think we'll start where we both probably agree,
Mm-hmm.
is that one of the biggest product market fits that we've seen in crypto are stable tokens,
No doubt.
right? So currently 70% of value that's transferred in crypto is transferred in stables.
Right.
So even though we have these store values, Bitcoin, potentially Ethereum, even the token economic design of Solana tends to want to rise with time. People tend to not want to use them transactionally.
That's right.
They want to hoard them, and instead, right, they're using predominantly USDC and USDT as mechanisms for actually transactionally using cryptocurrencies. And I think that's kind of where we agree on things.
Yeah, no doubt. Yeah, from my perspective, right, just to like zoom out a little bit, I think there's like 3 product market fits in crypto. Exactly three and only 3, right? There's a sovereign store of value in something like Bitcoin. There's programmable finance, if you're characterizing it optimistically or charitably, or degen casino, and meme tokens if you're maybe being a little less charitable. And then the middle one that we're talking about today is stablecoins, transactional and medium of exchange values.
Yeah, I mean, so to speak to stable tokens, it's interesting. Even in the crypto industry, if you hire a contractor,
Right.
Most people won't want to denominate their contracts in Bitcoin
Right.
or Ethereum, and most companies won't want to pay that out or sign the contracts.
Yeah. I've tried to get paid in Bitcoin denominated. The employers will not do it over long term because it is not in their favor.
Right. So in either case, volatility from the employee standpoint or potentially upside risk in the employer standpoint, it's just not used as a unit of account.
Yeah.
So what people do instead is you have to send money to a European contractor, let's say. You'll have a contract with them that says they're going to do this type of work for this many dollars per month, payable in USDC or USDT, and then you'll send them, USDT in every month, right?
Yeah.
Via, say, Ethereum, right? And you're going to end up paying anywhere from $5 to $40 fee for the privilege, depending on the network congestion. But what it really shows, right, is that we do absolutely need a unit of account for money, even with digital systems, market pricing of Bitcoin and Ethereum, and assuming we have liquid markets, they still aren't the preferred mechanisms of contracts and settlements because you can't even write the contracts in them, and the pricing is too volatile to really price goods, or in this case, services of workers in
for the
them.
Future over a period of time,
even monthly or
right.
It's not even doable, and that's one of the reasons that so much of the transactional value is happening in US denominated stables. So I guess it's really my premise with crypto. If we look at US denominated stables, a lot of people get stuck on this like TVL concept, total value locked, and they say it's a positive thing for crypto. So they'll say, look at Ethereum. Ethereum's so successful. It does all of these settlements in USDC. I think it is a very centralizing thing. If we look at, the issues with choke point 2.0 causing Silvergate and Silicon Valley Bank to go under 2 years ago now.
Yeah. Extrajudicial beheadings of banks.
Yes. That's exactly what took place. What we see is the using custodianed USD assets makes the USDC and potentially the protocols that have a lot of that USDC on them dependent on the financial system. So when Silicon Valley Bank went under, the price of USDC dropped to something like 82 cents because a lot of assets were held within SVB and people were concerned that they wouldn't be made whole. So it shows you that they're not any more robust or stable than the traditional financial system. And then the other sort of hidden thing that I see is that the protocols kind of become beholden to them if there's a lot of value. So in the case of USDC with Circle and Coinbase, if Janet Yellen decided to make a hard enforcement of OFAC within the Ethereum protocol and said, to Coinbase, Kraken, Circle, if you ever build on an OFAC compliant, on a block that isn't OFAC compliant, I'm going to pull your access to the banking system. Every single one of those parties would instantaneously comply. And so what we effectively have here is that, whatever that ask may or may not be, Janet Yellen already controls Ethereum via the banking access of Kraken, Circle, and Coinbase. And so she already sort of controls Ethereum. And if you want decentralized systems that are independent of control, you can't have those systems have a tremendous amount of value that's hypothecated and dependent on the traditional financial system. That's my biggest sort of gripe with USDC.
I wonder if that's any different, though. Is that any different from like Bitcoin or any other crypto asset if it is being transacted through those counterparties that you're discussing? Someone who's regulated, like a Circle, like a Kraken, like a Coinbase. I mean, at any point in time, a regulator can come through and say, even if it's Bitcoin, not just USDC. So I think I would yes, these are all issues. I would separate them out a bit. Because one is like the counterparty that you're transacting through, right? And that could be Bitcoin. It could be whatever the unit that or denomination that you are transacting with or via. If you're going through a counterparty like that is regulated under some regime, and to some extent, much of the world is regulated under an OFAC regime for better or worse. And we stop some bad things from happening, but we also stop a lot of good things from happening, unfortunately, and there's a lot of overreach. That's still a problem, even outside of stablecoins. I don't know that that's necessarily stablecoin specific. Now, I think there's a whole other set of issues that you're pointing out, rightly so, to examine for stablecoins, and one is that, well, what obligation does someone like Circle have, or Tether for that matter, of like monitoring the chain on an ongoing basis? And someone who DOJ, someone enforcing OFAC at the Treasury or otherwise could always come in and say, well, we think that Circle and Tether, you should have to monitor all secondary transactions of your USDC, not just like mint and redeem, but every single transaction on the chain. And if one of them not only goes to an address that we think is, like tainted in some capacity, but you're right, like included in a block with other transactions that aren't in your asset, we may take issue with that. We haven't seen that level of like hyper scrutiny yet, but it is possible. And then there's the issue of like, what are the underlying assets and where do they sit, right? And you're rightly discussing that today. Circle or Tether, they hold these assets at banks. Now that's changed a little bit. They don't hold them in banks as much. They hold them in money market funds from like BlackRock in Circle's case. And in Tether's case, used to be a pretty diverse portfolio that included like Chinese paper, U.S. paper, and Bitcoin and actually private equity and venture capital. I think they've reined in the risk profile of that a little bit. And they're like, whatever the number is, they're like the top 15 like T-bill holder in the world, but they are holding these assets with then traditional banking or financial institutions and or the actual Treasury Department itself, right? So that's interesting. I am seeing a movement, though, of obviously there's some quote unquote decentralized stablecoins, trying to create like synthetic versions of the dollar or price parity, or other mechanism by which it's kind of like a meta stablecoin, where it's a stablecoin that holds other stablecoins. So I don't know whether that's better or worse, but the reason why I'm bringing this up is I think there's like a couple different issues to discuss here that all present risk factors. Now, what I will say though, to play devil's advocate and be a little bit more positive on this, I think there is a large class of consumers and customers of these stablecoins across the world for which those risks are acceptable to them because the alternative is so bad locally, right? And so for them at this point in time, though these risks we just described are real and could be exploited, manipulated, or just in the course of business as it exists in the normal financial system play a real role, the alternatives locally are pretty bad for a lot of people in a lot of places. And a US dollar denominated stablecoin, even with these risks, is a better alternative.
Yeah, I mean, you clearly see that from market adoption, especially in places where you have unstable, hyperinflationary nation state fiats, right? Yeah. So, that statement is absolutely true, but just because it's better than something like fiat, I don't think we should try to stop improving on it from there.
No doubt.
In terms of the first point relative to using counterparties, this kind of goes back to maybe a very played out trope in the crypto space, which is not your keys, not your coins. Mm-hmm. Now, I will say that underlying that statement with certain blockchain systems is that you don't have good access because you don't have good throughput. Yeah. So ideally, right, everyone should custodian their own assets and should use their own keys and their own wallets to make transactions. They don't need a counterparty. However, with something that has incredibly low throughput, there start to become very good reasons that you will use counterparties to make transactions, just because the accessibility and the fee structure of doing something on chain doesn't work for a lot of use cases. But I think that's the less interesting of the three things to talk about. Let's assume that sort of we have a scalable system and people can easily hold their keys and they don't have to have counterparties to transact. I think then the next thing to talk about would be relative to the questions about sort of what happens to the decentralized nature of the systems when you have large amounts of RWAs, in this particular case, USDC, like stable tokens in the chain. And I think a good one to sort of think about there would maybe be, Bitcoin. If we look at Bitcoin and we sort of look at the mining profile, if we assume the mining profile is diverse, which I know economically speaking, there's conspiracies to say that that is not a diverse set of miners. But under a diverse miner assumption, Bitcoin is relatively sort of this independent, uncontrolled entity. So if you wanted to regulate it, the problem is anybody can enter the system. The areas in which they operate are probably every country on Earth using energy from every conceivable, generation source under 196 different sort of regulatory regimes. So there is sort of open access to that network. There's open access to get transactions into that network, even if you are a minority producer. So in that system, it is very sort of regulatorily resilient, and that you wouldn't be able to sort of change the protocol rules because one jurisdiction and one regulatory entity said, let's change them. What you would end up seeing is kind of smushing out of where mining is, because if the regulatory restrictions were so overbearing, miners would just leave said jurisdiction and go elsewhere. And I think that's like a really good property of Bitcoin, and people understand this about proof of work. And that it's like this purely open access system that will always sort of find the best, lowest cost place to operate. And that's like why it's such a cool idea. So on that construct, though, let's start thinking about the impact of having a stable token. Mm-hmm. So in that construct of sort of this decentralized mining, let's say, Bitcoin's worth $1 trillion, and suddenly I put a stable token denominated in dollars, it's worth $200 billion. Okay. that stable token that's in dollars is then going to again be under the purview of Janet Yellen by some mechanism, because if it's a custodian stable token, they're going to be held in banks that are under her jurisdiction, right? So, if Bitcoin has a fork, we at least have a tension here, which is, we have the independence of the miners, but it's competing with the regulatory authority that's dictating where these assets exist. So let's say there's like a conflict, and the miners, Janet says, okay, I need KYC on every account and don't build on non-KYC accounts. Some miners are going to be like, that's ridiculous, and just keep off and going mining. But there's going to be a lot of holders and potentially a number of miners that are related to these banks that have some interest in this $200 billion pool of assets, who are like, no, guys, this isn't like a big thing. Yeah. We're just trying to, stop crime and terrorism and all the other bad things in the world.
Or just the increasingly publicly traded in the U.S. corporatized miners who have actually a fiduciary duty to their shareholders, who are going to say, well, look, just for economic interests, we're going to continue to do this, right?
Yeah, or the simps for ETFs.
Yeah,
right. Everybody who's like, we want institutional inflows, so we want to have ETFs, and like we want to have these markets. Let's go off into this regulatory pathway,
large sect,
and you're going to get this fork, and the sort of ability and nature sort of dictate like where things go. You're going to have a fork at that point, and a lot of value is going to go off in this direction, and less value is going to go off in that direction potentially, because you have this RWA on chain. Yeah. So every time you do this, for whatever reason, it compromises the main tenet of the system, which is to have a decentralized sort of value system that has an immutable set of rules that can't be changed. But once you start putting all of this real world extra stuff on it that is completely orthogonal to the consensus mechanism, you're setting up a weakness of the consensus mechanism for the system to fracture in the future, because you have so much of that orthogonal value in the system. And that is like the principal weakness that I think does not need to be in the system, but it is because we don't have endogenous stable tokens.
Yeah, no doubt. And I've always disliked the term RWA or real world asset, just because like what we're doing in the digital space is also the real world, by the way. But setting that aside, and the fact that real world tokens like or assets came along, and then they already had stable coins, and that kind of got sucked up. But setting that aside, look, I agree, at a fundamental principle level, you have this beautifully designed system, these blockchains or cryptocurrencies that are totally endogenous in nature, and then you're trying to tack on all these exogenous things. That's ultimately what a real world asset is, right? Something that is exogenous. So that's why I don't like the term real world, because it's all the real world. But what you're talking about, actually, they should be called exogenous assets.
Yeah.
And so what we're talking about here, when you talk about, Ethereum has this whole system that's a blockchain, and whatever you think about Ethereum, it's contained here to some extent. And then you bring on a stablecoin that is exogenous by nature, both in terms of the value it's attempting to represent and the mechanisms by which it's representing it and bringing it on chain. It's all exogenous to the system. And so that's a natural tension that I think is the fundamental level that we're getting at here, is these things are never going to be totally in sync. And there's a whole bunch of ways in which they can fall out of sync pretty easily. That causes not only the exogenous part to fail, but potentially the endogenous part to fail as well.
Yeah, that's exactly right.
That's ultimately what we're saying, right?
Yeah.
Yeah. So I think where that gets us is, okay, well, great. How can we represent these things that we want, these characteristics, whether that's some sort of price predictability or price stability in terms of purchasing power or unit of account over time, and do it in a way that's exogenous, or more exogenous. Endogenous, my apologies, yes. So to restate, all of the things that we want, the value, the characteristics of these stablecoins or RWAs that we want, the price stability or price predictability in terms of purchasing power and a unit of account over time, but do it endogenously. And so far, the mechanisms by which we've attempted to do that in the cryptocurrency space have been the so-called decentralized stablecoins that basically create collateralized debt positions, usually is how it works, right? Meaning that like I put in some Ethereum or some quote unquote native or ERC20 style token in there that represents a value. And that serves as collateral for me being able to then mint the stable coin. And there's a bunch of different mechanisms to do this, but there's some mechanism by which we track the value of that collateral versus the redeemability and the value of that redemption of the token. And that's kind of how they've worked so far. None of them, DAI is probably the biggest for sure. That has, although DAI's a little different now, but
I mean, DAI's like a weird bird. Like
it is.
Originally, it was a pure CDP. But now it's like kind of a CDP, but it also has like a basket of goods that they hold.
And that's why they're splitting.
Other stable
I don't know if you've
tokens.
kept up with the split. Now they're calling one. They're splitting it going forward, where one is going to be kind of like the treasury and real world asset backed one, more of a regulated or exogenous world. And then one is trying to be more the decentralized world, but still not going as far as like the original vision of DAI and Maker, which was to be more of this. There's other ones that are better, but outside of DAI, which again is a little weird and kind of declining in relevance, frankly speaking, there's not been one at scale that's achieved that, unfortunately. So I wonder whether it's just the ways that they have been implemented have been faulty, or if just, they're not going to win against these centralized ones for the purposes that people want near term, or if it's just like that whole approach is faulty. I don't know. There. Do you have like an opinion on that, of where we stand there and what the right direction forward is?
Yeah, I mean, so obviously, like we have a proposal at Quai, which is Chi, which, not to get too deep into the weeds, but is the concept of creating an energy dollar. The way that we do that is we use the miners to kind of act as an oracle for the price of producing a hash, which is largely the price of electricity. And then with that, you can create a unit that is effectively proportional, to hash or electricity. So then that unit sort of has this consistency in purchasing power over time, ideally. And that's why we call it an energy dollar. Right. So the idea would be that instead of having to go sort of outside the chain or to, use a receipt, which effectively USDC is, to an asset, which is custodian outside of the chain, you can have your unit of account as part of the system. And then you sort of, because it's in the system now, you're not getting this exogenous set of influences on the consensus or the security of the protocol within the system, because the unit of account asset is native to the system. So we sort of remove this like second point of sort of creating these weaknesses or vulnerabilities in decentralization by having large amount of custodian-based assets. Mm-hmm. And that's really the proposal that, we're bringing forth, here at Quai.
Yeah, and it's an elegant idea, frankly speaking, is that the purest play version of like what the system is endogenously, right? The consensus mechanism, the proof of work mechanism that makes the whole system work, is also the oracle mechanism by which you are issuing this token that has certain stability properties, not to a dollar, of course, but to something that you can track endogenously on chain, which is miners' production cost, and then which ultimately on a marginal variable basis is energy. Yep. Frankly speaking. So that's like the purest play version of it. And actually, we're starting to see a new generation. I'm starting to see a new generation of stablecoins in the market. And you have these like USDC, USDT. You have these so-called decentralized ones that are different versions of collateralized debt positions and others. You're starting to see some non-dollarized ones, usually in fiat, of the same mechanisms. But now you're starting to see this new group, this new category of stablecoins that are saying, well, maybe the right path is to achieve robust stability rather than a rigid form of price pegging. Something that ultimately, as we said, achieves the goal that we talk about in a more robust way. That goal being price predictability or stability relative to purchasing power in an economic sense over some period of time, right? And the dollar doesn't have to be that. It could be some other mechanism that matters to our lives in an economic sense on a day-to-day basis. And energy, being the fundamental unit of every economy, both metabolic and financial, seems like a great choice for that.
Yeah, absolutely. Yeah, so I mean, with Chi, right, we're trying to sort of break this tie, and if we can create this sort of endogenous token, there's actually like an interesting implication to it that nobody, I think, has really realized yet. So to understand that implication, let's like go back to Ethereum with USDC for a second.
Mm-hmm.
When we were talking about TVL, that TVL is just value in banks, right? Ethereum didn't get that value put into Ethereum.
What do you mean it's a value in banks?
Yeah, when you look at USDC, there's $100 billion.
Okay, specifically the
right?
stablecoin TVL.
Yeah. So there's $100 billion in SVB. There isn't like $100 billion on Ethereum.
Right.
All Ethereum is doing is trading receipts of that money that's in SVB.
Representation.
So people are saying, oh, there's $100 billion of TVL. That doesn't mean anything.
Yeah.
There's $100 billion in SVB, and Ethereum is being used as an interchange network, much like Visa or MasterCard. And what is like the value of Visa or MasterCard? The actual sort of rip they take on a transaction is, 0.1% or less of the value of transaction. So yes, there's like a service that's being provided, there's fees that are being generated, but of the $100 billion that exists, none of that is on Ethereum. They're just there to provide and take these 0.1% sort of rips when people run transaction. The value doesn't exist in Ethereum. Now, the interesting point here is that if you make an endogenous token that has to be minted out of the system, that value is now part of that system. So for $100 billion worth of chi to exist, there had to be $100 billion that went into the system. But fundamentally, what you're unlocking here is a completely different category of value creation in blockchains that's never previously existed, where you can create stable tokens from the protocol.
Yeah.
Right? So I'll draw a parallel here. The reason that we've had such good standards of living in the United States is because the greatest export of the US for the last 80 years has been the US dollar. And that is because we set up an agreement with Bretton Woods that allowed it to be the reserve currency of the world. And it has enabled us to have the best standard of living, because when we print dollars, it isn't just sort of taxing the savings of our own citizens. It is taxing the globe and all of the reserves held globally that are needed to be able to transact in the reserve currency for international transactions, the dollar. So we've had this like great ability that we're effectively the base of the monetary system, and we've taken advantage of that because we can sort of print money and then buy goods with that money because the world is demanding the use of money. Now, the interesting thing is what we've said is these stores of values in sort of Bitcoin and Ethereum aren't the things that you demand to do transactions. So if we can sort of print dollars in the system, there's a whole new category of value that's being created that's never been created out of a cryptocurrency before. And my thesis is if you can create an energy dollar, the first blockchain to do that will be the US of cryptocurrencies.
Yeah, we might need a new term for TVL or total value locked that bifurcates to like total value represented, which is what it is today, versus total value created or something. TVC and TVR. I don't know what the right nomenclature is there, but it feels like these are two different concepts that should be described differently as well. But yeah, I think that like energy, compute, storage, bandwidth, these are like the resources of both the physical and digital worlds, realities that we live in, that underlie the economies that we're building, including the digital ones. So it seems to me that, the Holy Grail would be able to in a trust minimized endogenous way, be able to not only represent, but like naturally and natively create something that reflects that value in a, again, predictable, stable way relative to purchasing power over a period of time. And if you can do that, that would be a great foundation to build the new digital and physical economies for the 21st century and the information age going forward. I agree with that premise as well. It just seems, are we there yet? Do we have the technology? Can we do it?
Yeah, well, so there's a question about technology, certainly. I think the first thing that you have to have is you need a system that can scale in a proof of work setting, so that you can start to, have the technological ability to create something that is a unit of account. And really implicit with the unit of account is also really medium of exchange. So if you can't transact it for low fees sort of all the time, you can't really sort of meet this property that you need to create the unit of account, because if the unit of account, which is meant for transactions, can't be used transactionally, then it's still not really a good unit of account. So I think sort of the first technical hurdle is you need scalability, and if we're going to talk about doing it with an endogenous system, it needs to be scalability in a work-based setting. I think then the next hurdle that you have to get over is you have to get buy-in and sort of a maturity in the market that creates a monetary base. Now, the interesting thing about Quai and Chi in our system is that even if people do not demand Chi from a unit of account perspective, Chi natively functions as a proxy for hash rate futures. So even if I'm just a miner or a speculator in the system that has assets, I can make money by sort of predicting what I think the hash rate will be in the future by trading Quai and Chi. So there will always be sort of native demand for it because it acts as a proxy of a hash rate future, which starts to develop a monetary base. Now, the other thing that we have in our system, which is super interesting that we haven't really talked about a lot, is mined locked tokens. So when a miner is mining in Quai, they have a couple choices that they get to make. They have a choice of, do they want to take Quai as their reward, or do they want to take Chi as their reward? And then they also have the choice of when do they want to receive the reward versus how much the reward is. So there's sort of a lock period that exists that's relatively short in duration, much like Bitcoin. It's 1024 blocks. And that's sort of the minimum duration that they have to wait until sort of their mint is available to them to spend. Now, there's 3 other durations that we're adding into the system, which is 3 months, 6 months, and 12 months. And each one of those will have a different reward. And from the miner's perspective, they might think of that potentially as yield, because they could effectively take their money now and get like a rate, or they could take their money in 3, 6, or 12 months and sort of get a different reward, which would look like a rate. Now, to be clear though, this is only for mined tokens. You can't come in with stake and like lock it up and get yield. You only can mine a token and then defer the spending of your mint to get a different reward value. So we call these mined locked tokens.
Yeah, it's interesting because like one thing that like I think a lot of people also don't so many people I think like know so much about Bitcoin, but like not some of the nitty gritty. Like Bitcoin has this, they call it a cooling off period. When you mine a block, you don't just get it and can spend that Coinbase award right away. There's a cooling off period. That's, whatever it is, like 2 weeks or 24 blocks, whatever it is. Maybe it's 100 blocks. I don't know. But anyways, there's this cooling off period for Bitcoin transactions. And we have that as well. All proof of work systems do. But the next interesting thing is, so do I want it right after that cooling off period, in which case I get the amount that is the block reward? Do I want to get a slightly multiplied amount of that block reward in 3 months, a slightly more multiplied amount of that block reward in 6 months, or a slightly more, yet more multiplied amount of that block reward in 12 months? And what that is the price of money, which is the interest rate. That's like the definition of an interest rate, is the price of money over time. And what's interesting is you can't play with it with staked. You can only pay with mine. So you can only pay for it with electricity. So basically you're creating a market for the price of money in the system versus the cost of production with energy as the denomination. Yet again, reinforcing this. So I agree, that's like a very interesting mechanism there. And then of course, derivative markets you'd expect to be created or on top of that.
But before we get to the derivative aspect of it, let's just dig into this a little bit more. So in terms of the plan on the difference in rates, if you were to get one sort of Quai as a reward instantaneously after the cooling off period, the initial rate that we're offering is going to be 1.25 Quai in a year. So that looks like a If you were to try to class it as an APY of sorts, that'd be 25%.
Right.
Which is interesting. But the reason that we're doing that is because we made an interesting choice about mining and accessibility to mining, because we want to have the most decentralized system possible. So we picked an algorithm that is ProgPow, which is GPU friendly and not ASIC friendly. Now, that introduces a little bit of a problem in that GPU miners are more flighty because they don't have as much invested capital in the system. They're sort of instantaneously, choosing to mine this coin or mine that coin or do an AI job. So they're not sort of as sticky as Bitcoin miners in their economic choices. Now with ASICs, right, you have this sort of larger upfront capital cost that you have to depreciate over, 12 or 18 months.
It's not as transferable elsewhere.
Yeah. So Bitcoin miners have a stronger incentive to not screw with the protocol using their hash rate
up fixed capital.
Because they've locked up fixed capital. So the idea of locking the mine tokens is that creates a similar type of construct for the miners, wherein they are more aligned with the system over this, say, 12-month time frame, which then makes the security and the resilience of the system more similar to something like Bitcoin that uses an ASIC. However, the interesting part about GPUs is GPUs are more easily accessible for small miners, so you'll get a better distribution base, and they're also general purpose, so you have a better guarantee that people will have accessibility to GPUs everywhere in the world to be able to mine. And so that's kind of this like trade-off balance that we've taken, is we understand that locking up capital is important in terms of aligning the economic incentives of the miners in the system to sort of act in the incentivized cooperative behaviors of the system. But we don't want to do that by having application-specific hardware because of the centralizing forces that exist around that.
Right. No, it makes sense. Bottom line is, in a system designed like Bitcoin, you spend $1 million on ASIC hardware, great. You have $1 million that is kind of non-transferable. You can't use it for other stuff, by and large. And so you can only basically resell it on a secondary market to other Bitcoin miners. You can't use it on another crypto network to mine. You can't use it for things like LLMs, or rendering, or like some sort of like AU compute generalized job. So you have this, for lack of a better word, sunk cost into the system. So you are then incentivized to ensure that Bitcoin succeeds so that you can recoup the value of that investment over time, because you want Bitcoin to do well, because that means what you can squeeze out of that $1 million upfront fixed cost is more over time. Now, on the other hand, you want GPUs because, one, they don't have like super centralized supply chains that are more easily disruptible. They don't have the kind of like economies of scale that creates incentives to have a few gigantic mining farms versus at home or indie kind of like mid-sized miners. And then again, that capital upfront cost is also more accessible to people because they know they're going to be able to recoup it because they can use it elsewhere. But then you have the problem of, well, what's their sunk cost to defend the system and ensure that it has value over time so they can recoup it? And that's the mechanism that this plays, is it gives them kind of an optional but economically incentivized reason to
commit
capital
to the system.
That's right.
In a longer term time frame.
That's right. So that's an interesting balance that, like, I think a lot of people aren't aware of that spectrum. So this is like, again, an elegant kind of compromise solution that achieves both of those goals in a unique fashion. So I think that's a super interesting element. And then to get to the next level up, or do you want to?
Well, before we go there, what that means from a miner's perspective is if they were to choose Qi,
right,
not only are they able to mine in a stable, which from a miner's perspective is potentially advantageous, because if they're getting a token that's tracking the price of their production costs, they're effectively risk off when they choose to get paid in that token. The problem that miners suffer with something like Bitcoin is that they actually have to figure out how to hypothecate a neutral position because they're always inherently long. Right. But what they're trying to do from a business perspective isn't sort of YOLO long Bitcoin. It's to run it as a fixed income business that gets
an operating
return
business,
on
not a
capital.
speculating business.
That's right. So they have this thing where they have to figure out how to go short to stay neutral all the time, so they don't get sort of wiped out with crazy price movements. But with something like Qi, a miner could just choose to kind of take all of their profits in Qi, which then means that they don't have to go outside the system or create a hypothecated contract with a counterparty to take the neutral position point. So that's super beneficial for miners. Now, the other thing that it's doing, though, is if they choose to lock that up over time, not only are they getting a stable, but they're getting yield on it, which is super interesting too. So you have this energy dollar and you have this energy dollar that gets you yield. So this is the best of like so many worlds, right?
Yeah. No, I mean, it's an interesting dynamic, right? Because, and the point there about like an operating versus a speculating business, and the other aspect here is that Bitcoiners effectively want to then short Bitcoin to hedge themselves. Just like if I'm Delta or another global airline, I want to, and one of my biggest input costs is jet fuel or oil or gas or whatever. I'm like going to want to get exposure to that. It's kind of the other way. They want to get longs in the future.
They're short.
They're short
intrinsically.
They're short intrinsically, so they want to get long. Bitcoiners are intrinsically long, so they want to get short. So there's this kind of like interesting dynamic in Bitcoin mining where if you're a pure play operating mining company, you are going to buy Bitcoin short positions, which is kind of an interesting thing to think about when you're wondering how much they support the network or not. So I think that's another thing that this could take out of the system that could be very beneficial.
Yeah, absolutely. So there's a couple, like it seems like with all these sort of designs that we come up with, we're not just doing one thing with an idea, we're doing many things with an idea, and they all seem to sort of artfully play together, right?
Yeah.
So if you're looking at it, maybe there's 4 or 5 things we're kind of like accomplishing here with like a single design choice.
Yeah. And then, just to take the next step, like we were referencing earlier or alluding to, you'd expect then if Bitcoin, Quai miners, whether they're Quai mining Quai or Qi, and they're selecting, hey, I'm going to take the reward in 1 year's time or whatever horizon's time and get a multiplier on it, right? That's locked. I can't access that. But someone could come and create some sort of smart contract and trust minimized derivative structure that says, okay, but will you sell the right to that locked position in a year to someone else for what price? So the mechanism would be, okay, I'm a miner. I choose to take Quai or Qi in 1 year's time for some multiple of the current block reward. And so I have a right to access the address in a year's time, let's say, and get that like multiplied block reward amount. Well, can I give that access to someone else? And can I do that in a trust minimized smart contract, automated or autonomous way, and then sell that position? And so you're going to see, I think, these really interesting third parties coming in and creating sort of derivative or future contracts in a trust minimized automated way that's also going to contribute to a native price of money in the system.
Yeah, so I think what that would look like, right, is someone would create a smart contract that miners would be able to mine into.
Okay, yep.
Right, and they would basically like indicate that sort of they're like the beneficiary. Yeah. So the contract would be the beneficiary. They would put their address in so that the contract knows who's mining that token sort of into the contract. And then there's a whole number of things that people could do at that point.
Right.
From the very simple, you could take a single block reward and think of it as, if that block reward was 10 Quai, you could think of it as like a 10 Quai bond in some ways, wherein, and it's a little bit weird here because of like how they price bonds.
Yeah, it's more like I think you get to the bond. I think at first it's like a physically delivered or settled contract of 10 Quai is what you're getting. Hey, you buy the right to get this amount of Quai at this time in the future. Right?
Yeah, that's
and then you build on top of it, and I think you get to the bond in the next level.
Yeah. So the very first level would be, okay, let's say we have if the miner were to take it instantaneously, they would get 7.5 Quai.
Right.
If they were to take it in a year, they'd get 10 Quai.
Right.
So what they decide to do is they sort of mine into this contract. This contract now has this thing which will give you 10 Quai in a year.
Right.
Okay.
And the contract, I guess, like what the other step is, they mine into that contract as like the deliverable address, and what they get in return, I guess, would be a like liquid transferable right to access that. That's one. That's one way.
Depending on like how you want to do it, right? And you could basically say that they get sort of access to this guarantee in the future, which they could then trade in that contract or like a market built on top of that contract. Now, the interesting thing there is every block like sort of creates this like new
stream
bond like thing that has sort of continuous durations. So from a practical standpoint, you would imagine that if somebody was going to try to create this type of contract, they would want to have some sort of perpetual that's representing sort of a basket of this stream over time, so that people don't have to worry about sort of like singleton payouts. They can sort of put money in and sort of smooth the curve out like on sort of a horizon average duration. So you would expect them to see something that kind of looks like a perpetual with sort of a fixed yield at duration. And then the interesting thing there is then somebody with capital could come in, not necessarily with mining, but then they could buy these products, and then get yield on their money. So even though we're a proof of work system, because we're putting the cost of money into the system, there's a native outcome of having yield in the system.
Yeah, and it's like an emergent decentralized derivatives market. So
and David, it's not an Ouroboros.
It's not eating itself. It's not a self-perpetuating perpetual motion machine.
I mean, the yield is coming from the cost of money.
Right. It's also pricing it. Yeah, I mean, like, so it's really interesting to think that you could be a miner. If I'm a miner and I'm going to say I'm going to mine, let's say I mine 1 block a day based on like whatever I expect to mine 1 block a day. And I'm always going to take it in a year. And so every day I'm mining into this contract that says I'm getting a multiplied amount of that 1 year's time. And I get in exchange to that contract, a liquid tradable right to that in 1 year's time, every single day. Well, then what Carl's describing is that you take every single day and you bundle it up, package it up into like a perpetual contract to receive basically the price of this in 1 year's time. And you can do all sorts of exotic things when you like tranche a bunch of these things together that represent all sorts of different horizons and risks and things like that. So I think that's a really fascinating design. And the beautiful thing is, like, again, it's not like centralized, it's not top down, it's totally like emergent from the market itself, which makes it naturally more robust and efficient if you believe in markets, which I certainly do.
Yeah, I mean, that's like the whole design of everything
that,
like we're doing at Quai, right? If you study game theory, right, and that's really the design of blockchain systems, is you're trying to get things that are dominant strategy, incentive compatible, or at least Nash equilibrium when you sort of design the games. But what you're saying when you're doing that is you believe in economic markets to find these rational outcome points. So you just have to design rational outcome points and markets will find them, right?
Yeah. Interesting. So the last point that I really wanted to cover around these like stable coins, the other mechanism that we haven't talked about is like cash-like properties.
Well, hold on.
Okay.
Before we get to that, though, I just want to circle back on the implications of these derivative markets. So the implication is people like yield, right? So what's going to end up happening is if there is demand for yield, miners will decide to lock tokens to satisfy the demand for yield. So what will end up happening is the emissions that you expect from mining will be reduced by however much preference the miners have to lock up so that they can satisfy the demand for yield. Which potentially means that the emissions is deferred by a year to whatever degree that is, in part or in whole. which is like a pretty crazy dynamic from a proof of work blockchain perspective.
Right. Yeah, one of the challenges of proof of work blockchains is you basically have this streaming real-time new supply being sold into the market because miners have real costs on now that they have to pay the bills to keep up and running. And so you need to basically have X amount of new capital come into system every single day to maintain the price, a stable price. And so the concept being, well, hey, can you defer some of that new or reduce some of that required new capital into the system on an ongoing basis?
Well, you're attracting that capital by by creating an intrinsic cost of money and yield from that cost of money in the system.
Yeah.
So even though it is a proof of work system, it's also one that has a tremendous magnet for capital to come in that's seeking yield, which then makes it so that that sort of deflationary profile of the mints is pushed out because it's always instantaneously offset by new capital flowing in, which is exactly what you want if you want to establish a monetary base.
Yeah, I mean, these good proof, like blockchain systems, and in particular proof of work, Bitcoin, Quai, things like this, they are black holes for capital and liquidity. They just suck money and capital and monetary base and liquidity into the system if designed well. And that's what we're talking about here.
Yeah, well, and then the cool part about it is what this does is that it sets you up to quickly establish a monetary base because you're attracting capital in to sort of soak up the mining emissions through this yield incentive. But then what ends up happening in the longer term is as long as you can get growth in revenue through transactionally used fees, that capital doesn't sort of like hit the market until it's being offset by generation of fees that go to the protocol from people actually adopting a system. So it basically gives you like this year-long runway to figure out how to get a large amount of transactional revenue in the blockchain to offset the fees that are being generated through mining. So it's kind of like a beautiful system wherein you don't have this cold start problem where you have sort of like high emissions and prices like crash. And then you sort of like have this bathtub for like a super long time and you have poor security and you're just like sort of hoping and praying that you can get usership. What we're doing is we're deferring all of that so that you don't have hopefully that like dearth as all these tokens are emitted and there's no reason to come buy them because like the price is going to come down, right? With the idea here is that you always have the capital coming in to offset the mining emissions, which is like a beautiful design to bootstrap so that you can actually get users on the chain.
Well, that's the other thing. So what we're talking about here is not only an endogenous form of stable coin-like construction. We're talking about an endogenous form of like yield or price of money or capital in the system. I mean, the existing models, again, like Circle, Tether, and some of the other ones that are trying to like have some version of native yield. I mean, basically like Tether and Circle, they generally don't offer their users to share in that like yield upside. In fact, that's their like margin, right? But sometimes they do, like Coinbase will offer you rewards like as a secondary model or whatever, but it's totally dependent on what they're getting on the back end in the traditional financial system. Whatever they can earn off of their money market fund at BlackRock, that's what their yield. And like, sure, maybe they can share some of that with end users in some way, but it's not like it's not dependent on them. They're not in control of it. It's whatever like the traditional financial system, the money market and investments that they have are yielding, again, exogenous from the system.
Right.
So here we're talking about bringing an endogenously designed and like run market for that yield.
Yeah. So there's like an incentive initially, but long term, the cost of capital will be discovered in the system.
That's right. That's right. So
which no other system can argue they've done, even the current financial system, right? The cost of capital is set by a committee in a dot plot. Doesn't exist.
Yeah.
Right. And it isn't set by them or discovered by them. It is manipulated by them.
Yeah.
Right. Like dot plots aren't, for your benefit. It's for them to project onto you like what your expectations should be so that the outcome of the inflation and the CPI reflect the expectations that they set for you.
Yeah.
It is a brainwashing tool for the markets to like.
Well, brainwashing, it is top down, let's just say. It is not an appropriately, resiliently, robustly, or efficiently designed system. It is top down. It's
not
rigid.
market discovery.
It is not market discovery. It is fragile.
It is not a market discovery
and not
grade.
efficient. Yes, like 100%.
Right? Well, and a lot of the inefficiencies in our system, in banks, in taking outsized systemic risks and getting low returns for your capital in savings accounts and CDs, even in government bonds, arguably, all of that has to do with the fact that the rates aren't market discovered. Right. If there was a market discovered cost of money in the system, the whole world would instantaneously be more efficient.
Yeah. I mean, I guess like the argument, I'm trying to think what like the counter argument is that like, well, it is like there are some constraints. But like, yeah, again, with fiat, it's like really challenging because like those constraints are pretty loose. But like, I mean, there is some treasury and repo and other like markets that do have some price discovery mechanism. But again, it's from like this like small set of banks that are also tightly connected to the treasury or the central bank that is running these auctions. So it is a very rigidly and top-down design system, no doubt about that. So one thing I want to make sure that I was just hinting at that kind of like from my perspective ties out this discussion.
Well, is the fungibility piece.
Well,
but before we get that, let's just like summarize though.
Yeah.
Like what we've done here.
Yeah.
We figured out how to create an endogenous unit. We figured out how to create a system that prices money. That's never been done before.
Right.
And then we've also figured out a system that sort of creates good incentive in launch characteristics of a proof of work system
bootstrapping mechanism,
that can bootstrap to get usership of the chain. So with sort of this one feature, and we've potentially unlocked the thing that potentially has more value than any crypto has ever unlocked before, which is a unit of account, right? If you think about it, we've only ever hit store value, right? USDC isn't the endogenous unit of account, so they don't benefit from that production. First ones to do that. So pretty cool. We've done like 6 things here that really nobody's ever done before.
Yeah. No. And yeah, it's all tied together in one design, which is pretty fascinating. No doubt. Yeah. In fact, like there's probably more things we missed to summarize, but we just covered a lot. We'll have to run back the tape. But yeah, so the last thing on my docket here today is to describe this other element that if you were looking for like a native stablecoin or unit of account that you want to transact with and spend like cash, it should act like cash. And what do I mean by act like cash? It should be fungible and relatively peer-to-peer private bearer style instrument, right? And all of the stablecoin designs that I'm familiar with today, none of the stablecoins designs that I'm familiar with that exist today have any like inkling of these properties that I'm discussing. They're all like an account-based IOU like ledger that has no fixed denominations. It has no sort of like peer-to-peer bearer instrument, like private transaction characteristics, things like that. There are some privacy stable coins that I think are now trying to be developed on some of these ZK chains, but none of them have, I don't think, launched yet or like had a design that I've seen that seemed effective in these, means.
So when we get down to it, right, let's say that Ethereum could scale and could always guarantee you single penny fees on USDC transactions.
Right.
Let's just start there. They can't, obviously.
Yeah.
But let's just say they did that. The interesting thing is because it's an account-based ledger that is this immutable set, it's visible by everybody. I don't think any businesses that have competitors would want to adopt that system because it's just fundamentally economically uncompetitive to do so.
Yeah.
Because if I go into my Chipotle and I buy a burrito, the Freebirds across the street is going to be able to look at the chain, see when my customers come in, how much they're paying, what things that they're buying, how much I'm sending to my suppliers for all the locations all over the world that like I sell burritos, right? So
it's incredibly hard to like obfuscate on chain. It's one of the funny things when cryptocurrencies get accused of facilitating illicit activity on chain. It's like, this is the last thing you'd want to use. And it's for these same reasons where like having been in an exchange like Kraken before, where like you have these like kind of waterfalls of hot and cold and warm wallets. And sometimes you want to like reveal that for a proof of reserve, but most of the time you don't want others to see that, it's incredibly difficult, if
Yeah.
not impossible, to shield your private transaction internal history from others. It's
Yeah.
incredibly difficult,
Yeah,
if not impossible.
I mean, I would honestly argue that every transaction that's like ever been done on Bitcoin, if not already known, like will be known in the future.
Yes.
And the same is probably true for anything that isn't.
It's
like,
actually my
explicitly
biggest concern for Bitcoin. My biggest concern about Bitcoin, and you know I'm like a huge Bitcoin fan and Bitcoin bull, but like it's not some of like the economic sustainability stuff and security budget stuff. It's privacy.
Yeah, well, so fundamentally though, like I don't think you can have a capitalistic, laissez-faire economic system where everything is seen by everybody else.
The same thing for speech. It's why the First Amendment has not just the freedom of speech, it's the right of assembly and being able to like gather in pubs quietly and privately without prying eyes. It's the same concept.
Yeah, but like I don't even think you can get laissez-faire outcomes if everything is on chain because everything is discoverable.
I'm saying the same thing for a democracy and free speech is to like this and economics.
Yeah, there's definitely like parallelism here. Yeah, totally. For sure. You know, so that being said, you know, it's great that we can create an endogenous unit of account, but I would argue that it's useless without having some properties of being a medium of exchange. Right. And if we look at, you know, the Chipotle Freebird example again, you know, when I go into Chipotle with a $20 bill.
Is Freebird a chain? I'm not familiar. Is that
it's an Austin one.
Oh, okay. So I'm not even. So maybe the viewers are. I'm not. I was like, I thought you were just talking about like a freewheeler or something like that. So Freebird's like a competing chain. Got it. Okay.
They're like it's
either
Austin or Texas centric.
Okay, I'll check it out. All right.
Yeah, they have better salsa.
Oh. That's a hot tip.
But you know, you go in with a $20 bill to Chipotle. Freebirds doesn't know about that, right? I just, you know, get a $5 back and, you know, Chipotle will reconcile that at some point.
They can look at the parking lot and see how many cars are there. And in fact, hedge funds do
that.
Alternative data sets that do this. But you're right. That's a very crude mechanism.
Freebirds don't know about that. So we can create systems where we have transactions that happen in competitive environments and can do so competitively, right? That's what cash provides us. And even if I look at credit cards, it's the same way, right? When I, you know, spend my money with a Visa swipe, they're not sharing that information with everybody. So, you know, I mean,
yes, you're right, of course. But I'm talking about the resale market. But they aggregate it, generally speaking, and they only do targeted marketing. But yes, they don't see, certainly not your competitor can see every single transaction.
You know, they might get data on you.
I'm with you.
But they won't get data on that specific transaction.
I'll save that rant for another one.
Yeah, fair. So, you know, we have sort of these siloed ledgers. We have these like more private systems with cash that we need to have a functioning competitive economy. And I think we can all agree that competitive economies are how we get efficient outcomes.
Right.
Okay. So the thing is with crypto, if they're completely transparent right now, they are completely inadequate for being used as a transactional mechanism in a competitive economy.
Right.
So if we create a unit of account without giving it properties of a medium of exchange, we've gotten ourselves not very far. So the idea with Chi is that it is also a system that has what I would call cash-like properties. It's not sort of a strictly privacy designed system like Monero where you have perfect sender, receiver, privacy, all this stuff. You know, with ring signatures and crazy zero knowledge sort of proving or Peterson commitments. What we do with Chi is we basically say it's a UTXO ledger like Bitcoin, but we make it fixed denominations. So there's only 16 denominations in the system. And so when I send money, as long as I'm sort of good with my use of addresses, it doesn't sort of permanently make that transaction attributable to any single party or any single recipient.
And when you're saying
in the system,
fixed denominations, you're talking about a $1 bill is a one denominator, a $5 bill, a $20 bill, so on.
We actually copied the U.S. denominations.
Right. So it's not like, the point of it isn't like some sort of like obscure privacy mechanism. It's just spends like cash.
It spends exactly like cash. So if you design a UTXO system where each UTXO represents a bill or a coin. Now we added we added a thousandth of a cent, or like a thousandth of a chi
Right.
coin,
So-
and
so,
and
yeah.
like a
This is smaller than a
5,000th
penny,
of a
yeah.
chi.
Yeah,
But we did that because, you know, there's some use cases in the digital world where you want
Yeah,
like
yeah,
sort of micro
yeah,
transactions
micro
or payments.
streaming, whatever. Yeah,
But
yeah.
but otherwise, it's literally like
Yeah.
U.S. denominations, and we actually went further up too, because we were saying if you only have 100,
Yeah.
you're gonna have, it's gonna be data cumbersome
Yeah.
to like hold larger amounts of
And
value.
there's still
So
there's some higher U.S. denominations, although I don't know like how.
there used to be a
I don't know.
10,000.
Yeah, I don't know if they're all in circulation anymore. I'll have
But
to double check that.
no,
yeah.
so I think the $10,000 notes still are
I think
like
there's
acceptable.
definitely higher than 100. I just don't know. Like there used to be a bunch, but I think there's
Yeah.
only building 1 or 2 now.
Yeah, so the 10,000 I think are still acceptable. So
Yeah.
that's the highest unit
Yeah.
actually. So we go 10,000 down to 1,000th of a chi.
Yeah.
Roughly following the U.S. denomination
Yeah.
path. So we have a quarter, and we have a 10, and we have a 20, and we have a 50, and 100, so on and so forth. So like largely speaking, we're following
Yeah.
the same denomination cash,
Mhm.
with chi. But what that does is that when you spend it, you can get cash-like guarantees. So if I walk into Chipotle, when I spend my money, it's not going to permanently say on chain that at this time on this date in
Yeah.
this like location, Dr. K got a steak burrito and paid $12.69 for it.
And it's not just the Freebird or like McDonald's, or well, I guess McDonald's is Chipotle now, but Taco Bell across the street looking at Chipotle. It's also Chipotle looking at you.
Yeah.
If I spend my money at Chipotle, Chipotle shouldn't be able to see what else I'm spending my money on that day or the next day, right?
Yeah, that's right.
And so that's the exact same thing here. That's why cash is so good, right? And that's why we need intermediaries like Visa or others to obfuscate that. Because when you go on this on-chain mechanism, if I send from my Bitcoin or other wallet to some merchant that I'm buying something from, they can say, and maybe I've given my identity, maybe not, depending on what that purchase is, they can say, well, these are the other things this guy is spending his money on.
Yeah. So I mean, what it does though is it allows the system to function like cash. Now, if people wanted to try to regulate or crack down on it, and were like, you need to do KYC AML to buy a burrito, that's fine, I guess.
It's fine.
Yeah, but then they have to explicitly do it.
Yeah.
You're not getting it revealed by the mechanism of your payment.
Right.
They have to go in and say, this is like what we want to do as a regulator in this society, and then do it.
I'm an optimist. I've heard people say that if the US dollar cash was invented today, it would be outlawed. Now, I'm more of an optimist. So I actually believe that, like, why would there be anything wrong with creating a cash-like system? This is how money has worked in our forever. And today, now, of course, everyone's trying to go cashless, and again, the like less charitable, more pessimistic people say for surveillance, and certainly there is a lot of surveillance that goes along with it, but a lot of it's just convenience. A lot of it's just data and being able to use that.
But let me play the counterpoint here. Even when cash was more ubiquitous and we didn't have digital settlement, people were able to look and have surveillance in the banks.
Oh yeah.
Right. So like if you come in,
totally.
Even in 1980, and you're like, here's like a pile of cash, the banks would be like,
yeah,
where'd you get that from again?
That's right. If you were carrying around a suitcase full of like $100 bills, like you've always been able to see that was suspicious if you wanted to think that was suspicious.
Yeah. Well, and that's like a whole nother discussion. But my point is, even with cash, there are mechanisms to find and track criminal activity.
Yeah, of course.
Right? You don't need an open, immutable ledger where everybody knows what everybody is spending on everything 100%. All of the time to do law enforcement.
Yeah.
That is like completely unrequired. It didn't exist, right? Until recent times.
We had laws and they were enforced for a long period of time.
Right. And people could use mechanisms and be creative and do investigations and things, and they could find stuff using alternative mechanisms than putting complete surveillance inside the money. That is not a requirement to do law enforcement.
That's right.
Right? Like that is the point. And I will say it is a requirement for a laissez-faire capitalistic society.
That's right.
Which we need.
Yeah.
Right.
And this is why I think like this is probably one of the more under-discussed components of well, cryptocurrency in general, but like stablecoins in particular, that like none of them are even close on this stuff. Like you can argue some of the other elements, well, like they're better than alternatives, like we were talking about earlier. Even like if you're in Argentina or Turkey or whatever else, maybe it's okay to use a USDC or a USDT given your alternatives. And I agree, we should strive for more, but like that's one thing. Here, they're not even like coming close to the existing bar on this front, and that's I think one thing that goes super under discussed with stablecoins.
Yeah, no, I mean if we look at that too, it's weird. There definitely is sort of counterparty risk here. I don't, personally use Coinbase, but I know other people that do. And they've reported that they'll have income from mining, and they'll have that in USDC, and they'll try to send it to Coinbase and cash it out. And Coinbase will say, okay, where'd you get it from? And they'll say, okay, I do mining. And then they'll say, okay, show me your electricity bills and the receipts from the, hardware that you purchased. So it's getting like in those USDC things, it's like crazy onerous about what you have to do to actually redeem that USDC through the issuer. So it's not like a risk-free stable token asset is I guess the point here.
I've had better experiences with Coinbase and Kraken, but yeah, I think if you're probably one of the few folks who actually creates and redeems from Circle or Tether, they have like certainly another level up of like compliance and regulatory responsibilities that they have to be a little bit more intrusive with.
Well,
no doubt about it.
But I guess the bigger point though is like there is risk that
100%.
you have this digital asset,
100%.
and they definitely have a knob where they can turn that digital asset off if they do not want you to have it for whatever reason. And it doesn't even have to be just not letting you redeem it on the exchange. They literally can shut it down on the blockchain.
Yeah, no doubt. So we've covered a lot of ground here. We kind of like extended our last conversation around decentralizing stablecoins and some of the centralizing vectors that exist today and how Quai and Qi are kind of solving those. I think we extended it pretty far today with some of the miner incentives, GPUs, the miner lock mechanisms, and then some of the like cash-like properties pretty far. I think we'll probably need another segment on some of the cash-like stuff and maybe even the miner economic stuff. But for today, I don't know. This like puts a pin in it for me. But anything else that you wanted to cover on this one?
Yeah, no, I think that's pretty good coverage. Next time maybe we can explore the market dynamics that the yield might have.
Totally.
The yield.
Yeah, quote unquote.
No, I think that's like an interesting one. Just because then there's sort of like this balance between sort of the miners producing these assets and like capital coming in, and they're kind of like splitting it depending on the relative ratios of supply and demand. There's a whole set of discussions there. But for today, I think we covered a lot of ground about what you can do in Qi. And I don't think we've ever covered this before.
No, I don't think so
either. We've only really covered the basics of the ideas of mechanics.
We'll continue this. Well, our first conversation is like scouting, or we're going forward and we're covering a lot of ground, and then we'll go deep on these ones in the next sessions.
Cool. Appreciate it, David.
Awesome.